Hello, Carl. Cathie Wood started the year as a bona fide superstar in the rarified world of active stock picking. She ends the year still a superstar, but the ebb and flow of her flagship fund illustrates the danger of being an aggressive active stock picker. Among her largest holdings, Block, Coinbase, Unity Software, Zoom Video, they're all down more than 10% just in December alone, with lesser declines for Twilio, Teladoc, Spotify, and a 3% decline for her largest holding. That, of course, is Tesla. Now, yesterday, Wood lightened up on many positions, selling stakes in most of her major holdings. As for inflows and outflows, the inflows peaked very early this year. However, given the volatile stocks that she owns, holders of her flagship fund, the Ark Innovation Fund, they've been remarkably loyal. Since peaking in April with 201 million shares outstanding, there has been a slow but steady trickle of outflows. There's now 173 million shares outstanding. Okay, that's down 15% from the April peak, but that level has been fairly steady in the last few weeks. That's very impressive, given the fund is down 21% this year and it's 38% off its 52-week high. It hit that high way back in February, and it hit an intraday low for the year just a few weeks ago. So a lot of people are sticking with her. The bottom line is this: there's nothing wrong with Cathie Wood's main line of reasoning. Disruptive technology companies will change the world. Well, that's true enough, but when everyone buys into the argument and prices go through the roof for companies like Teladoc or Twilio or Spotify or Unity Software that currently make little or no profit at all, or like Roku or Block or Tesla, they trade for enormous multiple to earnings, some investors are going to inevitably start questioning what the right price should be. You know, guys, it's not that Cathie Wood failed. She didn't fail. She actually succeeded. She convinced the world to go along with her. The problem was everyone bought into the story, and they drove through the prices through the roof. And that's what we're debating now. What's the right price for these companies? Back
and
to you.
She has... Yeah. She has a longer time horizon, so we got to give it a few more years. We'll see what shakes out. Bob, something that we don't tend to talk a ton about is the fee structure, because it's not a hedge fund with 2%. But even with the poor performance of Ark ETFs this year, Cathie Wood laughing all the way to the bank.
75 basis points. So that's what we're charging. Think about this. You can buy the S&P 500 for 3 basis points. That's the lowest price to get into it right now. 3 basis points for the S&P 500 versus 75 for Cathie Wood. Now, she does that because she does a lot of work. She's got people working for her, research. So it's not that it's not justifiable. It certainly is. But you can buy the S&P 500 for 3. So there, of course, is when that debate becomes very relevant. Should you just put the money into a actively managed fund like Cathie Wood and pay 75 basis points, or should you just put it into a fund that is essentially just tracking the S&P 500 like the Spider S&P 500 and pay 3 basis points? You decide, but a lot of people in the last few years have been putting money into, of course, those indexed funds.
Hey, Bob, everyone's sort of watching to see if she tweaks her model or adjusts her long-term philosophy. I know on Squawk a few weeks ago, she did say they were starting to experiment with a long-short model in-house, potentially rolling it out later on. I wonder how material you think that would be.
Well, I would find that a little surprising because, remember, the whole game here is invest in disruptive technology. And she's been right. These companies have done well. The problem is she just drove the prices through the roof because everyone bought into that particular story. So it's hard finding these companies at their youngest point. Look at the Coinbase, the whole up and down. It's been crazy all year with Coinbase because investors pull money and pull money out because you can't figure out what the company's long-term prospects are going to be. This is what's really hard about active management. This is why people say go into index funds like the S&P 500. It's really hard. And when you're dealing with disruptive technologies, you're not buying industrials, it really gets difficult. It illustrates how hard it is. But I really laud her. I think she's got a terrific outlook. I hope she doesn't start adopting long-short models, though. That would kind of be against the theme of what she's doing.
She said she may, right? Shorting may be next for a fund, but we have to laud her transparency as well, Bob. It's certainly been something to cover.